In today's video, we are breaking down a powerful interview with Tom Lee, the head of research and chief investment officer at Fundstrat Capital, where he addresses what is really happening in the crypto markets and why he believes investors are panicking at exactly the wrong time. Tom Lee recently joined CNBC's Closing Bell to talk about the sharp drawdowns in crypto, the state of 𝗣𝗟𝗏's business, and the broader implications for investors who are reacting emotionally to recent price action. His core message is clear. I am first going to show you the clip of Tom Lee on CNBC so you can hear his comments directly in his own words. After that, I will come back and give you my personal reaction and breakdown of what he said, including what I agree with, what I think investors may still be missing, and why this moment matters more than most people realize. After that, I will walk you through an in-depth analysis of 2 AI stocks Wall Street is quietly buying for the next stage of AI. If you find this analysis valuable, make sure to hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you do not miss the next important financial investing update. Now let's hear what Tom Lee has to say.
Tom Lee, who's so timely to speak with not only for Dow 50K and the jump back in tech, but also as the chairman of 𝗣𝗟𝗏. Tom, I know you're watching what's taking place in crypto. We're talking about a 7-month low for the stock, 𝗣𝗟𝗏, the Ethereum paper losses, $8 billion. Is this in jeopardy of going into a pretty dark place?
Hi, Scott. Thanks for having me. 𝗣𝗟𝗏 is designed to be a vehicle that tracks Ethereum prices, but on the upswing, because we're adding Ethereum, we'll outperform. So Ethereum's in a drawdown. 𝗣𝗟𝗏's going to be in this drawdown, Scott. 𝗣𝗟𝗏 has no leverage. It has roughly 4.3 million Ethereum that earns 3% annually. And we have 600 million cash earning about 4% in money markets. So the company is making about $1 million a day. So there is no risk, no need for the company to actually raise money because it's debt-free and actually generates about $360 million a year in net income. I think crypto sentiment is rock bottom because it has been a terrible drawdown. I mean, just the past 10 days, Ethereum's down 40%. And that's triggered, I think, a lot of concerns about whether crypto is even viable. But, all of those statements that I just heard from just a minute ago, I heard the same thing in November 2022 after FTX. And that's the reality, that crypto is sort of characterized by hypervolatility and big drawdowns. I mean, just in the last 8 years, Ethereum's had 7 drawdowns of 60% or more. The good news is 7 of those were all V-shaped recovery. So we had a waterfall decline. If crypto's bottoming now, which it kind of looks like it is, especially given MicroStrategy's 25% move, the recoveries are V-shaped. So we recover as quickly as we've fallen.
Just want to follow up on that. Where you suggest there's no risk to the company, is that assumption that Ethereum has stopped going down, that this is a bottom? If there is what some have predicted to be a coming, quote-unquote, death spiral for certain cryptocurrencies, if the situation with Ethereum gets worse, what happens here?
Well, yeah, I mean, it's a fair question. I think we can look at metrics, for instance. If you look at the number of active addresses on Ethereum, it's up 117% versus a year ago. In fact, in just the last 3 months, that's actually gone up parabolically. As you know, coming out of Davos, what was the big story around what Wall Street plans to do? It's tokenization, which is moving a lot of their financial infrastructure onto the blockchain, Scott. That's not going to change just because crypto prices have fallen. But what is the blockchain that is evident, listed, named by whether it's UBS, Standard Chartered, or Fidelity, where they're tokenizing products? It's on Ethereum. So Ethereum is not in a death spiral because the utility is going up. The price, of course, has been awful. Unfortunately, crypto prices are volatile. It's not like earnings estimates change for Ethereum. In fact, network usage is up 80% in just the last 6 months. But it does mean prices move a lot. I mean, it's sort of a feature of crypto itself.
The conversation opens with a very important framing, and that is the idea that leverage can end badly when unwinds begin. That line alone sets the emotional tone for the entire discussion, because when markets are falling fast, especially something as volatile as crypto, the first instinct investors have is to assume something is breaking, and usually when something breaks in financial markets, leverage is involved. Forced liquidations, margin calls, and debt structures tend to turn drawdowns into disasters. So when Scott brings Tom Lee in, the real question hanging over the conversation is not just whether prices are down, but whether the situation is structurally dangerous. Tom immediately addresses that by explaining what Bitmain actually is designed to do. He says very clearly that Bitmain is meant to track Ethereum prices, but outperform on the upside. That is an important distinction because many people hear a crypto-related stock or vehicle and assume it is heavily leveraged or financially engineered. Tom goes out of his way to say that is not the case here. He emphasizes that Bitmain has no leverage. That is not a throwaway line. That is the foundation of his entire argument. He then lays out the balance sheet in a very deliberate way. Roughly 4.3 million Ethereum earning about 3% annually, plus $600 million in cash earning around 4% in money markets. When he says the company is making about $1 million a day, that is meant to calm nerves. He is saying this is not a distressed entity scrambling to survive a downturn. It is a cash-generating vehicle even in a falling market. From my perspective, this is where the conversation starts to matter beyond just crypto enthusiasts. Because whether you like crypto or not, this is how you should be thinking about any investment tied to volatile assets. The first question should always be balance sheet risk. Is there leverage? Is there forced selling risk? Is there a liquidity crunch hiding beneath the surface? Tom's answer here is very clear. No leverage, no debt, no need to raise capital. That alone separates this situation from many of the blow-ups people are mentally associating with crypto. Then he shifts to sentiment, and I think this is where Tom Lee is most consistent with his broader market philosophy. He says crypto sentiment is rock bottom, not weak, not cautious, rock bottom. And he backs that up by pointing to the sheer violence of the drawdown. Ethereum down 40% in just 10 days. That kind of move shakes confidence even among long-term believers. It forces people to question whether the asset class is viable at all. What I find interesting here is how quickly narratives repeat. Tom mentions November 2022 after FTX, and that immediately resonated with me, because if you were paying attention then, the language being used now is almost identical. Back then, it was existential. Crypto is dead. The industry is broken. Regulation will crush it. And yet, here we are again with the same emotional cycle playing out after another brutal drawdown. Tom reminds viewers that hypervolatility and massive drawdowns are not anomalies in crypto. They are features. He points out that Ethereum has experienced 7 drawdowns of 60% or more in the last 8 years. That is a staggering statistic if you are used to traditional equities. But then he adds the most important part. 7 out of 7 of those drawdowns were followed by V-shaped recoveries. This is where I want to pause and inject my own view. Historical patterns are helpful, but they are not guarantees. Just because something recovered 7 times does not mean it must recover an 8th time. However, ignoring that history entirely is just as dangerous. What Tom is really saying is that if you choose to participate in crypto, you must accept this level of volatility as part of the deal. If you cannot emotionally or financially survive a 60% drawdown, then this asset class is simply not for you. He then suggests that crypto might be bottoming, pointing to MicroStrategy's 25% move as a potential signal. Whether or not that proves to be the bottom, the broader point is that recoveries in crypto tend to be fast and violent, just like the declines. You do not get gentle reversals, you get waterfalls down and rockets up. That is why timing this market is so difficult. Scott then presses him, and I think this follow-up question is exactly what skeptical investors would ask. Is there really no risk? Is this assumption dependent on Ethereum having already bottomed? And what happens if Ethereum enters what some have called a death spiral? This is where Tom pivots from price to fundamentals. He does not say prices cannot go lower. Instead, he brings up usage metrics. Active addresses on Ethereum up 117% year over year. Even more striking, he says activity has gone parabolic in the last 3 months. That matters because price and utility are not the same thing. Markets can misprice assets in the short term, but usage trends tell you whether something is becoming more or less relevant. He then ties this to what he heard coming out of Davos, which is tokenization. Wall Street moving financial infrastructure onto the blockchain. That is not a speculative meme. That is banks, asset managers, and financial institutions experimenting with how to modernize settlement, custody, and issuance. And Tom makes a very specific point. When these institutions talk about tokenization, they are not choosing random blockchains. They are using Ethereum. This is one of the strongest parts of his argument, because it reframes Ethereum not as a speculative token, but as infrastructure. If UBS, Standard Chartered, and Fidelity are tokenizing products on Ethereum, that suggests the network is becoming embedded in the plumbing of finance. That kind of utility does not disappear just because prices fall. Now, personally, I think this is where nuance is required. Institutional experimentation does not automatically translate into mass adoption or guaranteed long-term dominance. But it does undermine the idea of a death spiral. A death spiral implies declining relevance. What Tom is describing is the opposite: utility increasing while price collapses. That divergence is uncomfortable, but it is not unprecedented in emerging technologies. He acknowledges that prices have been awful. He does not sugarcoat that, and I appreciate that honesty. Too many commentators pretend price does not matter at all. It does. Price affects sentiment, capital formation, and public perception. But he also points out something important. Ethereum does not have earnings estimates in the traditional sense. You are not revising EPS downward because of a bad quarter. You are watching a network go through cycles of speculation and disillusionment while usage trends continue underneath. To me, this interview is less about calling a bottom and more about reminding investors how to think during periods of maximum pessimism. Tom Lee is essentially saying that if you believed in the long-term thesis when prices were higher, the only thing that has changed is price. Balance sheets are intact, usage is growing, institutions are still building. What has changed is sentiment. That does not mean prices must immediately reverse, but it does mean the narrative that everything is collapsing may be overstated. And historically, those moments of narrative extremism tend to coincide with opportunity, not certainty, but opportunity. At the same time, I think viewers should be careful not to confuse resilience with immunity. Crypto remains one of the most volatile asset classes in existence. Drawdowns like this can take longer to resolve than people expect. Regulatory risks still exist, technological competition still exists, but the idea that Ethereum is spiraling into irrelevance does not line up with the data Tom is pointing to. Ultimately, this interview reinforces a broader lesson that applies far beyond crypto. When markets are under stress, the most important questions are not about price, but about structure, leverage, and utility. Tom Lee's argument is that Ethereum and vehicles tied to it without leverage are experiencing pain, not collapse. And historically, pain has been the entry point for long-term recoveries. Whether you agree with him or not, this is exactly the kind of framework investors should be listening to during moments like this. Not hype, not panic, but balance sheets, usage, and long-term adoption trends. Now let's dive in and reveal the two stocks that Wall Street quietly believes could outperform over the next stage of the artificial intelligence revolution. Let's start with the first AI stock that many investors are underestimating: ServiceNow Inc., ticker NOW. ServiceNow is far more than just your typical enterprise software company. On the surface, it is a leader in workflow automation and cloud-based enterprise solutions for IT service management. Historically, that has been its bread and butter, but in recent years, ServiceNow has transformed itself into a platform that deeply integrates artificial intelligence, automation, and intelligent agent orchestration into the core of how companies run their operations. Wall Street analysts have begun to take this transformation seriously. Analysts specifically cited the company's AI potential, calling it a disruptive platform that is early in its transformation to leverage artificial intelligence across a massive enterprise software market. ServiceNow meets most of the best-of-breed criteria for competitive advantage because of its deep enterprise integrations, platform architecture, high switching costs, and vertical specialization. These are the exact kinds of traits you want to see in long-term compounders, especially in technology where incumbents with entrenched positions can often continue winning decade after decade. What makes ServiceNow stand out is not just the buzz around AI, but the way it is embedding intelligence into existing workflows that businesses rely on every day. Its Now Assist suite, a collection of generative AI products, has continued to grow rapidly in annual contract value. What started as a modest addition to ServiceNow's offerings recently reached about $600 million in ACV, and management expects that to exceed $1 billion by the end of 2026. That kind of growth at $1 billion run rate from a new product line inside a company that already generates consistent high-margin recurring revenue is a very powerful signal of both adoption and monetization. To put this in perspective, think about what generative AI means for enterprises at scale. Historically, many organizations have struggled with fragmented systems, disconnected data silos, and repetitive manual tasks that require significant human effort. ServiceNow's approach is to act as a unifying platform, an AI control tower that connects systems, processes, and data from across the enterprise into a single workflow. This kind of orchestration becomes exponentially more valuable as AI capabilities expand. Every step that can be automated, predicted, or enhanced by AI adds measurable productivity to a business. And this is important because when enterprise customers begin relying on these systems for mission-critical processes, IT operations, human resource workflows, legal and compliance tracking, customer support, and more, they become much harder to replace. That translates directly into high switching costs and long-term recurring revenue. That is exactly what you want when you are evaluating a long-term growth stock rather than a speculative trade. At the same time, ServiceNow has been making strategic acquisitions to bolster its AI capabilities and deepen its moat. For example, its purchase of AI startup Moveworks for almost $3 billion was aimed at accelerating its generative AI offerings and expanding its footprint into front office and customer service management use cases. That deal reflects a willingness to invest heavily on top of organic innovation to ensure the platform continues to lead in AI-enhanced solutions. Perhaps even more telling is the move by ServiceNow's CEO Bill McDermott to purchase $20 million worth of company stock personally and to publicly commit to leading the company through 2030. Insider purchases of this magnitude from a sitting CEO are rare, especially outside of stock compensation, and it signals confidence in the company's long-term trajectory that goes beyond typical executive incentives. When the person responsible for steering the business is putting their own capital on the line, that speaks loudly about conviction and alignment with shareholders. From a financial standpoint, ServiceNow has consistently delivered strong growth. Its subscription-based revenue model produces predictable cash flow, and metrics like remaining performance obligations, which is effectively deferred revenue that companies expect to realize in the future, have been growing at double-digit rates. That gives investors a forward view of revenue potential as clients continue to expand their use of the platform and adopt new AI capabilities. It is true that in the past year the stock has faced pressure and some short-term volatility, with shares trading below prior highs and recent dips creating a buying opportunity rather than a collapse. But volatility in growth stocks should not scare long-term investors when the underlying fundamentals remain robust and the secular drivers are intact. And unlike many early-stage AI names that depend on hype or promise, ServiceNow is generating real revenue from AI today while expanding into new workflow domains that are deeply embedded in enterprise operations. Another powerful tailwind for ServiceNow is its expanding partnerships with other major technology players. For example, its collaboration with frontier AI provider OpenAI enables direct integration of advanced models within the ServiceNow platform. This partnership is not just about branding. It gives enterprise customers access to state-of-the-art models without needing to build or maintain custom infrastructure. Analysts have noted that this kind of collaboration underscores ServiceNow's role in enabling AI consumption at scale across organizations that might otherwise struggle with deployment or integration on their own. Let me be clear about something. When you evaluate an AI stock today, you need to separate short-term hype from long-term structural value. ServiceNow fits the latter category. Yes, it is influenced by broader software and tech sentiment. Yes, near-term price action can feel volatile, but the story here is durable growth built on recurring revenue, expanding AI adoption, strategic acquisitions, strong enterprise relationships, and long runways in multiple high-growth markets. That combination is exactly what institutional investors look for when they quietly build positions ahead of broader plays. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us turn to the second stock on this list, which represents a very different type of AI play, but one that is equally compelling when you think structurally about how artificial intelligence is transforming industries. Thomson Reuters 𝗗𝗜𝗦𝗖𝗢𝗨𝗦, ticker TRI, may not look like your typical AI investment at first glance. When most people think about AI stocks, they think of flashy tools, chatbots, or cutting-edge models. Thomson Reuters is none of those things. Instead, it is a long-established content and technology company that provides indispensable information services, legal research tools, tax and accounting workflow solutions, and a suite of products used around the world by professionals every day. Its core businesses generate recurring revenue and are deeply integrated into the decision-making of law firms, corporate legal departments, accounting firms, and government agencies alike. This is important because AI is not going to replace valuable content and domain expertise. It is going to enhance it. Firms like Thomson Reuters are uniquely positioned because they combine proprietary data, decades of curated content, expert editorial oversight, and workflow tools that professionals trust. This is not commodity data. This is high-value content that requires deep subject matter expertise to produce and verify. That barrier to entry is a powerful competitive moat. Recent developments underline how Thomson Reuters is embracing AI to expand its value proposition rather than be disrupted by it. The company's latest financial results showed solid revenue growth in its key segments including legal professionals, tax and accounting, and corporate services. These core units continue to grow organically, even while the broader market reassesses traditional software names under pressure from new AI entrants. The growth in these high-margin recurring revenue streams shows that demand for professional-grade tools remains strong, even in an uncertain macro environment. It is also notable that AI-driven features are increasingly part of the company's offerings, with assessments that generative AI now represents a larger proportion of underlying contract value year over year. That means clients are not only buying the traditional databases and workflow tools, but also paying for enhanced capabilities that leverage artificial intelligence to increase productivity and insight. Now I want to emphasize something key. Thomson Reuters is not an overnight AI play. It does not rely on speculation about future models or unproven markets. It is a cash flow generating business with a long history, stable demand, and deep entrenched customer relationships. That is precisely why many institutional investors have been quietly accumulating shares in names like TRI. They see a company that is benefiting from AI adoption not through luck or hype, but because clients trust its tools and are willing to pay for advancements that make professionals more efficient and effective. Even in moments where the stock has underperformed broader indices, the strategy makes sense for a long-term investor. In fact, earlier this year the stock traded near multi-year lows despite solid earnings and organic revenue growth, and analysts continued to project meaningful upside based on fundamentals and future expansion opportunities. Consensus forecasts indicate a significant potential increase in fair value over the next 12 months, driven by a combination of AI-enabled product adoption, recurring revenue strength, and steady dividend growth. From a valuation perspective, the fact that Thomson Reuters yields a healthy dividend while still investing aggressively in AI solutions makes it appealing to long-term investors who want both income and growth exposure. Dividend-increasing companies with real economic moats tend to outperform over extended time horizons because they reward shareholders while still innovating and capturing new revenue streams. It is also worth noting that recent market coverage of broader AI advancements may cause short-term volatility in stocks like TRI, but those moves often represent fear rather than fundamentals. Legacy incumbents with proprietary data and essential services rarely disappear overnight. Instead, they evolve and integrate new technology to enhance their value proposition. That is precisely what we are seeing with Thomson Reuters. The company is expanding its AI capabilities internally and through acquisitions, augmenting its professional workflows so that customers benefit from both legacy strength and cutting-edge innovation. That makes it a very unique position for a long-term AI investor, exposure to the secular AI trend without betting on unproven technologies. Now that we have covered both ServiceNow and Thomson Reuters in depth, I want to ask you this question. Of these two very different businesses, which one do you think has the stronger long-term AI moat, and why? Let me know your answer in the comments section below because I read every comment and your perspective matters to me. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.